Dear students, I welcome you all to this last session of second chapter, that is Theory Base of Accounting, part 4. In the last class, we have discussed the last 3 accounting concepts, that is the concept of conservatism, which states that anticipate all probable losses and provide for it, but do not consider anticipated profits. That is the policy of conservatism, isn't it? And next we have seen the concept of materiality, which states that all material facts relating to the organization should be shown in the books of accounts, and no material facts relating to the transaction should be hidden. That is materiality concept. And next we have seen the objectivity concept, which states that the transactions to be recorded in the books of account must be supported by proper business documents such as invoice, cash memo, receipts or vouchers, isn't it? And after that we have discussed the systems of accounting. In that we have seen the double entry system and the accounts from incomplete records, isn't it? And next, basis of accounting. In that we have seen cash basis and the accrual basis. And next we have seen accounting standards. Accounting standards, where we have seen that accounting standards are written policy documents covering the aspects of recognition, measurement, treatment, presentation and disclosure of accounting transactions in financial statements. And even we have seen accounting standard is an authoritative statement issued by ICAI, a professional body of accounting in India, isn't it? Accounting standard is an authoritative statement issued by ICAI, a professional body of accounting in India. And ICAI means, Institute of Chartered Accountants of India. Institute of Chartered Accountants of India. And next, we know that the objective of accounting standard is to bring uniformity in different accounting policies for enhancing reliability of financial statements. In order to bring reliability to the accounting information, it should be uniform, or there should be some uniformity in different accounting policies, so that it enhances its reliability. And for that we need to have some standards, and such standards are called accounting standards. And next we have touched even IFRS, International Financial Reporting Standards. International Financial Reporting Standards. And International Financial Reporting Standards are globally accepted accounting standards. They are globally accepted accounting standards developed by International Accounting Standards Board, an international institution. International Accounting Standards Board has developed some accounting standards, and such accounting standards are called International Financial Reporting Standards, IFRS. Actually, they are set of accounting standards for reporting different types of business transactions and events in the financial statements. And we have seen in India, IFRS has been converged as Ind AS. IFRS has been converged or changed as Ind AS, Indian Accounting Standards, and there are many accounting standards in India. To name a few, I have made a small list. In book there is a big list. I have taken just an abstract, 3-4 accounting standards I have taken here, and it will be explained as and when the time comes. Table showing few Indian accounting standards, Ind AS, they are called Ind AS. Number 1, Ind AS 1 deals with presentation of financial statements. How to present the financial statements will be guided by Ind AS 1. Similarly, Ind AS 2 deals with inventories, valuation of inventories, etc. Next, Ind AS 7 deals with cash flow statements, which you are supposed to study in the next year. Okay, cash flow statements. Similarly, Ind AS 10 deals with events after the balance sheet date or contingent events. Next, Ind AS 11 concerned with construction contracts. These are some of the Indian accounting standards. All the list not necessary here. Okay, that's about IFRS, International Financial Reporting Standards, and in India they are converged as Ind AS. Earlier also we have Indian accounting standards. Now we call it as Ind accounting standards. Okay, Ind accounting standards. That's about IFRS. Now let's move on to see one more concept in this topic, which has been introduced before last year, that is very buzzword in the last 2 years or 3 years. So, okay, that is Goods and Services Tax, GST. All of you might have heard elsewhere, GST. ಯಾಕೆಂದರೆ ಎಲ್ಲ ಕಡೆ ಇದು ಸುದ್ದಿಯಲ್ಲಿ ಇರತಕ್ಕಂಥ ಶಬ್ದ, ಬಜ್ ವರ್ಡ್ ಅಂತ ಕರಿತೇವೆ. ಗೂಡ್ಸ್ ಅಂಡ್ ಸರ್ವಿಸಸ್ ಟ್ಯಾಕ್ಸ್, GST, one country one tax, also called one country one tax. GST, a smart taxation system. Goods and service tax, GST, one country one tax. Now let's see what exactly this GST mean. Before going to see the meaning of GST, I think it is better to have some idea regarding tax. What is tax? ತೆರಿಗೆ ಅಂತ ಕರೀತಾರೆ ಕನ್ನಡದಲ್ಲಿ. What is tax? You know, even in history you might have come across with this term tax. King used to levy the tax on the citizens. What is this tax? See, in simple words, it's the amount paid or payable by the citizens to the government on some transactions or on some income. Okay, but it is compulsory. So tax is a compulsory contribution to state revenue. Tax is a compulsory contribution to state revenue levied by the government on income, workers' income and business profits, or added to the cost of some goods or services, added to the cost of some goods or services, and even on some transactions. So tax is a compulsory contribution to state revenue levied by the government on income or profits or on cost of some goods or services and on some transactions, that is tax. Okay, all of you know actually in other subjects you might have studied it. Tax, or even as a general knowledge you may be knowing tax is the amount payable by the citizens to the state. State means government here. Earlier citizens used to pay tax to the kings, Now citizens used to pay tax to the government. That is tax. It's a compulsory. We cannot evade it or we cannot escape from it. It is a compulsory contribution to state revenue. That's about the meaning of tax. Now let's move on to see the meaning of GST, goods and service tax. And before going to see the exact meaning of GST, let's see how different taxes were collected by the government with special reference to India. And taxes in India taxes are broadly classified into two types: indirect taxes and direct taxes. Indirect taxes and direct taxes. And indirect taxes are again classified into two types: indirect taxes collected by the center and indirect taxes collected by the state. And collected by the center includes service tax, excise duty, then CST, central sales tax, customs duty, etc. And the state collects the indirect tax like VAT, entry tax, octroi, luxury tax, etc. And on the direct tax side we have mainly the income tax. Perhaps there are other taxes. I will refer here only one tax, that is income tax, and it is direct tax. This is the existing tax structure before the arrival of the GST. And there was a lot of discussion to remove these taxes collected by the center and state, and in that place the policy makers decided to bring one tax, and that one tax is GST. So all the central and state taxes, majority of the central and state taxes are replaced by GST in the year 2017. That is on 1st July 2017, GST came into effect in India. So earlier taxes were classified into two types: indirect taxes and direct taxes. And in the indirect tax there were different types of taxes. Some taxes were levied by the center and some taxes were levied by the state. As you see, service tax, excise duty, CST, customs were levied by center, and again state levies VAT, entry tax, octroi, luxury tax, etc. But all the tax were replaced by a single tax. One country, one tax. All the taxes were replaced by a single tax, that is GST. Now let's see what is this GST. GST is a destination based tax. GST is a destination based tax on consumption of goods and services. It's a destination based tax on consumption of goods and services, and it is levied at all stages, right from manufacture up to the final consumption. It is levied at all stages, right from manufacture up to the final consumption. And now basically you should know it's a destination based tax or consumption based tax. It's a destination based tax on consumption of goods and services. Now the question comes, what is this destination based tax? Actually there are two classifications, destination based tax and origin based tax or production based tax. We are not supposed to discuss that origin based tax. We are supposed to discuss this destination based tax. What it means? Because GST is a destination based tax. Destination based tax means tax based on destination of goods or services. Tax based on destination of goods or services. This principle seeks to tax the goods and services on simple theory that the goods or services should be taxed in the jurisdiction where their consumption takes place rather than the point where their origin or production takes place. So, GST is a destination based tax, and destination based tax means collecting the tax based on the consumption area and not on the production area. It is a tax or destination based tax is a policy or principle which says that you should or goods or services should be taxed in the jurisdiction where their consumption takes place rather than the point where their origin or production takes place. Take for example, A of Gujarat produces goods and sells to A of Gujarat produces and sells goods to B of Rajasthan. In this case, tax should be levied and collected or accrued to the state of Rajasthan because consumption takes place at Rajasthan. So, this tax is to be collected, or this tax will be the income or revenue to the state of Rajasthan and not to the state of Gujarat. It will be the income for the state of Rajasthan. That is destination based tax. If it is taxed in Gujarat only, it becomes origin based tax or production based tax. Consumption takes place in Rajasthan, so collect the tax in Rajasthan. Then it is destination based tax. If you tax it in Gujarat only, then it is, or if it becomes revenue to the Gujarat government, then it is production based tax or origin based tax. Forget about that. We are more concerned with destination based tax. I hope you got it. Destination based tax is a system where goods and services are taxed at the point of consumption rather than at the point of production. What it means? It's a method where goods and services are taxed at the point of consumption or in the jurisdiction of the consumption and not at the point of production. So now let's move on to see further. GST has a dual aspect with the center and state simultaneously levying a common tax base. GST has a dual aspect because here center on the one side, state on the other, simultaneously they tax. GST has a dual aspect with the center and state simultaneously levying a common tax base. They commonly use the tax base and collect the tax. So GST has three components. GST has three components, and they are, as you can see there, CGST, SGST and the IGST. CGST, SGST and IGST. There are three components. GST involves three components. One is the CGST, other one is the SGST and the third one is IGST. CGST, SGST and IGST. And what is this CGST? CGST means Central Goods and Services Tax. CGST means, you can see there better, Central Goods and Services Tax. And these taxes are collected by the center, or CGST collected will constitute the revenues of the central government. CGST collected or amount collected by way of CGST will become revenue to the central government. Will become revenue to the central government. That is CGST. Central Goods and Services Tax. And next, SGST. What is this SGST? SGST means State Goods and Services Tax. State Goods and Services Tax. And a collection of SGST is the revenue of the state government. Collection of SGST is the revenue of the state government here. It's the revenue of the state government. How actually CGST and SGST are collected and they will become revenue for the center as well as the state. GST includes basically three components: CGST, SGST and IGST. And tax collected as SGST will become revenue to the state government. For example, Ramesh of Karnataka sells goods worth rupees 10,000 to Rajesh of Karnataka. Ramesh of Karnataka sells goods to Rajesh of Karnataka. Both are staying in the same state. Remember, both are staying in the same state. So destination and origin. Origin and destination lies in the same state, that is in Karnataka. How much goods he sells? He sells goods worth rupees 10,000. Then if the GST rate is 18%, if the GST rate is 18%, how 18%? Two GSTs, central GST and state GST. So there are two components. If GST is 18%, it includes two components. One is CGST, total is 18%, then it may be 9% and 9%, assume. When total is 18%, 9% CGST and 9% SGST, then how the revenue is to be divided? 9% on 10,000 comes to 900. 9% on 10,000 comes to 900 will go to central government. 900 will go to central government. And remaining 9% on the 10,000 comes to 900 again. That 900 goes to state government. In place of all other taxes, now only one tax exists, isn't it? Earlier, center used to, of course, center used to levy CST and state used to levy VAT and other taxes, but entry taxes, etc. Now all other taxes removed, and in place of that we have only GST in all in place of all other taxes, we have only one tax, that is GST. Assume if it is 18%, 9% to the state and 9% to the center. That is how SGST works. Next, one more is IGST. What it says? IGST. Integrated Goods and Services Tax. IGST means Integrated Goods and Services Tax. And revenue collected under IGST is divided between central and state government as per the rate specified by the government. Here, in case of IGST, it is Integrated Goods and Service Tax. Revenue collected under IGST is divided between center and state. If the state is involved in that particular transaction, it will be divided among the states. Okay, central and state government as per the rate specified by the government. It is divided. IGST collected by the center will be divided among the center and the state governments. Okay. Next, IGST is charged on transfer of goods and services. IGST is charged on transfer of goods and services from one state to another. Means IGST comes only when there is the transaction or dealings between two states. If Ramesh of Karnataka sells goods to Rajesh of Karnataka, there will not be any IGST. But if Ramesh of Karnataka sells Rohan of Maharashtra, then IGST comes, because here goods or services are transferred, or goods are transferred from Karnataka to Maharashtra, involves two states. In such case, we used to charge IGST, integrated GST, and even import of goods and services are also covered under IGST. Okay, that's about three components of GST. First, what we have learned? GST is a destination based tax. It's a destination based tax, and it involves three components, that is CGST, SGST and IGST. Now let's move on to see how it works. GST works, particularly when we have to charge CGST, when we have to charge SGST, and when IGST comes. Okay. There are two types of transactions here: intra-state transactions and interstate transactions. Intra-state means within the state. Intra-state movement, goods and services movement. If it is within the state, Ramesh of Karnataka, Rajesh of Karnataka, what it is? It is intra-state movement. Intra-state movement. And the other one is interstate movement. In case of intra-state movement, CGST and SGST are charged. In case of intra-state movement, CGST and SGST are charged. And in case of CGST, GST is levied by the center. GST is levied by the center. And in case of SGST, GST is levied by the state. If the transactions or dealings is within the state, that is intra-state movement, when there is intra-state movement, or when the transaction involves intra-state movement, the GST includes CGST and SGST. It includes CGST and SGST. CGST is levied by the center. GST is levied by the center in case of CGST, and GST is levied by the state in case of SGST. And in case of interstate movement, we have to charge IGST, that is integrated goods and service tax. In case of IGST, GST is levied by the center and states concurrently. Center and state concurrently. That's about CGST, SGST and IGST. In case of intra-state movement of goods and services, we need to charge CGST and SGST, and in case of interstate movement, there comes IGST. Okay. Next, let's move on to see in brief one or two characteristics. Already we have discussed now. In brief, let me touch 2-3 characteristics. One is, GST is a common law and procedure throughout the country under single administration. That's why the very name, one country, one tax. GST is a common law. There is no discrimination. It applies to all. Common law and procedure throughout the country under single administration. That's one characteristic feature of this GST. And second one is, GST is a destination based tax. Already discussed. It's a destination based tax and levied at single point at the time of consumption of goods and services. It's a destination based tax levied at single point at the time of consumption of goods and services. And next, one more feature is, it's a comprehensive levy. GST is a comprehensive levy and collection on both goods and services at the same rate with benefit of input tax credit or subtraction of value. There is a chance to make input tax credit or subtract the tax already adjusted. Okay, that's another feature. It's a comprehensive levy. And one more thing is, when we apply GST, no other tax will be levied by the center or the state. VAT will not be levied or CST will not be levied. All other tax are removed and only single tax is applicable, that is GST. These are some salient features of this GST, and in book you may go through few points. Okay. And next one is advantages of GST. There are many points in the books. I have taken only 2-3 points. One is, introduction of GST has resulted in abolition of multiple types of taxes in goods and services. That we have already seen today, isn't it? That center used to charge service tax, then CST, then customs, and state used to charge luxury tax, entry tax, VAT, value added tax, isn't it? But all such taxes are abolished, and in place of that now we have only one tax, that is GST. Okay, goods and services tax. When there is only one tax, it is advantageous to the government as well as the consumers. Okay. Next, GST widens the tax base and increased revenue to center and state. GST widens the tax base. As there is only one tax, it has increased the revenue to center and state, and it has also reduced compliance cost. It has also reduced compliance cost because in entire country there is only one tax so far as indirect taxes are considered, that is GST. So government can easily monitor it, and even it has encouraged the voluntary compliance. It has given some number, and every businessman is supposed to keep that particular number, and he is supposed to file the return within the specified date, and as such compliance cost has also decreased and voluntary compliance has increased. That's another advantage to the government. This is about advantages of GST. And one more you may include here is GST affected rates of tax to the maximum of 2 floor rates, but it may be changed. It may be changed. And next, let me make a recollection of this topic. We have completed here chapter 2 with discussion of GST, and let me have a glance over the things we have discussed in this chapter. And we have started the chapter with GAAP, isn't it? Generally accepted accounting principle. Regarding theory base of accounting, we started with GAAP, and then we have discussed basic accounting concepts. Basic accounting concepts, we have already made discussion about 13 concepts, isn't it? Starting from business entity concept, which says that owner and business are two specifically identifiable business units. Owner is different, business is different, isn't it? Next, money measurement concept, which says that only those transactions which can be expressible in terms of money should be recorded in the books of account, or all items should be expressed in money terms, isn't it? And next, going concern concept, which says that business entity is supposed to be in existence for a long period of time, for an indefinite period, long period of time. And next, accounting period concept says that the owner of the business will ascertain the result of the business and financial position of the business at periodic intervals, and that interval is called accounting period. Generally, a period of 12 months is considered as an ideal accounting period, and it may be the financial year of the government, or it may be the calendar year. Okay. Next, cost concept, which says that all fixed assets should be recorded in the books at their cost, and in each year it may be depreciated. Okay. Next, dual aspect concept we have discussed. What it says, every business transaction will have two effects. One is the benefit receiving aspect, and the other one is the benefit giving aspect, and they are technically called debit aspect and credit aspect. And we have seen that accounting equation also. What it says, assets of the business are always equal to the liabilities plus capital. Assets of the business are always equal to the liabilities plus capital. This is the fundamental equation, I said, on which the entire accounting is based, or entire double entry system of accounting is based. Next, revenue recognition concept, which says that revenue is said to be recognized when it is earned, and even though it is not actually received, we have to consider it as revenue. And then matching concept, which says that periodically the revenue of the business are to be matched with the expenses connected with earning that revenue, isn't it, to ascertain the profit or loss, or to ascertain the result of the business. And then full disclosure concept, which says that all material facts should be disclosed in the books of account. And next, no item should be hidden. Consistency concept says that the methods and policies followed should be consistent. It should not change time and again, isn't it? And next, conservatism concept, what it says, anticipate all probable losses and provide for it, but do not consider anticipated profits. Then materiality concept says all material facts should be shown. Then objectivity concept says all transactions should be recorded in the books only when it is supported by proper evidence, isn't it? These are the accounting concepts on which, the basic concepts on which the entire accounting is based actually, and you should always remember this. ಅದನ್ನು ಬಯಾರ್ಟ್ ಮಾಡೋದು ಅಂತ ಅಲ್ಲ, ಆದರೆ ಇದು ನಿಮಗೆ ಯಾವಾಗಲೂ ಐಡಿಯಾ ಇರಬೇಕು. ಓಕೆ, ನೆಕ್ಸ್ಟ್ we have discussed systems of accounting, and in that we have discussed two systems, double entry system and single entry system. And double entry system is based on the fundamental principle that every debit must have a corresponding credit, isn't it? And next we have discussed about basis of accounting. In that there are two bases, cash basis and accrual basis, cash basis and accrual basis. And then we have discussed accounting standards, and in that we have seen the abbreviation, full form of that ICAR, Institute of Chartered Accountants of India, which gives the authoritative guidelines for carrying on the accounting profession, isn't it, or for carrying on the accounting practice. It gives authoritative statements, and such statements are called accounting standards. Institute of Chartered Accountants of India is the highest accounting body in India. Okay, next IFRS, International Financial Reporting System, or reporting standards rather, International Financial Reporting Standards we have seen. And last we have discussed GST, that is goods and service tax. So with this I will wind up this topic. I hope I have come up to your expectation to some extent. Thank you.